now. All right, so I want to quickly take us through what's been happening this week and the strategy that we use and the reason why we use the strategy that we use. Okay, so the strategy that we use is we trade on the 4-hour. The reason why I prefer to trade on the 4-hour, you don't have to trade on the 4 if you don't want, but the reason why I do it is because I don't want to be held hostage to my charts. I've got a life to live. I've got a family. I've got friends. I want to at least, be doing some stuff except trading. So that's why I trade on the 4-hour, which means I have to check my candles 4 times a day: 7 o'clock, 11 o'clock, 3 o'clock, and 7 o'clock. So I check my candles now when the trades came in, and then I am done for the night. I put my phone down and I go back into the market tomorrow again. Okay, it's not weekend, but that's how I trade. And the reason why I trade that way is because I want a life. So if this is the type of trading that you are looking for, if this is how you want to be making passive money, then you are at the right strategy and you're at the right place. So from an indicator's perspective, we only use one indicator, and that is the moving averages. Okay, not exponential, no funny. We just use the moving average. That's it. We don't use any funny moving averages. I don't want the exponential. I want the MACD. Let's put this one. There we go. So we use the simple moving average. We use 4 of them, and then we use one EMA, and we use SMA. Simple moving averages. So we use 4 of those. It's gonna give me that. Oh, I need to put the bands in. Okay. Where's my bands? I forgot. This thing keeps kicking this out. Alright, let me just guys, just bear with me here. Let me just take out this. I forgot that we had a special indicator that we used there. That's the exponential moving average, and then we have the 4 moving averages. 4 moving averages. There we go. I think this is the right one. Just want to make sure if it's this one. Let me just check it. No, yeah, it's this one. All right, so we use these moving averages, and the reason why we use these moving averages is because we trade the way that the bank trades. So the system that we trade is called, no, it's not this one. The system that we use is called a hedging strategy. And the reason why we use a hedging strategy, because it is powerful. It allows us to have a life. It allows us to take trades when trades shows itself. I just want to see the one that they set up with all of the. I just want to see. I don't know why mine's deleted out of here. Let's quickly have a look here. I've already got so many moving averages now. No, I don't want this one. I don't want the preset one. Ah, here it is. 4. Okay, that's it. Okay, I was a bit confused there. Alright, so the one that we use is this one. And the reason why we use that is we use 4 different moving averages. The first one is the 32. The second moving average is the 50. The third one is the 100. And the fourth one is the 200. Now you ask yourself, Marnie, why are we using so many moving averages? Pretty simple, because that is exactly the way the banks trade. So what you're going to be learning with me is how does the banks trade. Why do we want to trade like the banks? Because the banks moves the market. There is no retail trader that can move the market. Unfortunately not. It is the bank that decides which way the market goes, and that's why we trade the way the bank trades. Okay, so there's our 4 moving averages, and then the EMA that we use is an 8 period moving average, and this is exactly, so the way you are looking at your chart today is exactly the same way the bank is looking at the charts. So any retail trader that is trading for the bank, they are looking at the exact same thing. All right, so as a matter of fact, as I am on the Zoom here right now, the strategy, how it works is as follows. So when we trade, we take an upwards position when we have the second candle that opens. So this is your breakthrough candle. So let me just zoom in here because I want you guys to fully understand this. So the way that we trade is we check for the first candle, right? So this is the first candle that broke up. So this candle broke up. This candle went through the white line. So we are paying attention to the white line. So let's make it a little bit thicker so that everybody here can see it. All right, so a little bit thicker so you guys can clearly see it. And don't be afraid. You can set yours as thick as you want. It's entirely up to you. But it's important that you have a look at it. So we are watching the white line. That's the 8 EMA, right? So this is the one that we trade along. I'll explain what the other moving averages mean now. So what we do is the first candle that breaks through this white line. This is the first one. We open a trade. This is the first candle that opened above it. This is the breakthrough candle. This is the opening candle. So this is the second candle that opened, right? So what do we do here? We take a trade here. So we take a trade. We have no stop loss. We have no take profit because we are going to see where the market takes us. Now, this is obviously a very good example because the market went directly in our direction. So the question is, where do we get out of the trade? Now, there's 2 areas and only 2 times that we will get out of a trade. We will get out of a trade when we see a doji. And now what is a doji? A doji is pretty much a candle that has it has a long wick like here. So one of the dojis, this one you could have taken as a doji. This one maybe, but I would have seen that it's still pushing up. But let's say that you got out on the doji that we got out here. So we got out on this doji right here. So the question is, how much was this move? Well, if you put your trade in there, no stop loss, and you literally went up and you got out there, you would have made 257 pips. Now, 257 pips on a $100 account, that is pretty much over $2.57 that you took. You just increased your account by 2.5%, right? So this is crazy. This is really, really easy, simple, and crazy. Like really, this is the easiest strategy. Once you understand the strategy and you know how we trade, you will see how amazing it is. So let's say, for argument's sake, you got scared and you said, okay, I don't want to watch the market anymore. I'm going to get out when I see the first doji. So this would have pretty much, it's not completely a doji, but I would have said that's also a doji. So you could have gotten afraid and you said, okay, no, I'm going to get out on that doji. So you would have gotten out here. Now, even when you get out here, we're talking about 168 pips. Now, 168 pips on a $100. We're not talking about even $1,000. $100 account is $1.68. You made 1.68% on your account with one single trade. So this is pretty much the strategy that we trade. So if you did not have a doji, there's a second time that you climb out of the trade. That would be when the second candle opens under the 8 EMA, right? So this means here is a breakthrough candle. This is the first candle that opened. This is the second candle that opened. Now, if you're like me, I've been trading for a while, so I'm not really fussy. I'll only get out of trades when I see that the momentum is down and that. So on this trade, if you got out there by that candle, that means that you made a total of 258 pips, right? 258 pips is what you made on this trade. That's exactly the same amount you would have made if you got out on the doji. The reason why we get out on the doji is because the doji pretty much tells us there's a market reversal. Look there. There's one. It's not a strong one. The thinner the bar, the better it is. But this one already would have indicated us market is slowing down. We need to get out. And if you didn't believe this one and you didn't believe that one, you would have eventually gotten this one. This is like a book, cookie cutter, perfect doji. You could have gotten out here and said, okay, no, I'm not going to try my luck any further. I'm going to get out of the market here. And you would have caught that entire swing. So what do we then do? If you don't climb it on the doji and you don't see it, when the second candle opens below the 80 we will then take a short position. So that's pretty much what I did. Is I was riding 258 pips. Here, I closed my trade and I opened a short. And I rode it down, down, down. There's my first candle. Broke through. And on the second opening of the candle, I took the trade. No stop losses, no take profits, nothing. That's why this is the easiest strategy you can ever apply. Now the question you ask is, how successful? I mean, Marnie, everybody says you cannot trade without a stop loss. You cannot trade without a take profit. Well, I have been doing it for over 3 months. My mentor has been doing it for over 8 years. And he's averaging between $50 to $100 a day using this exact strategy, because the reality of the situation is the banks want you to use a stop loss, because when you use a stop loss, that is how they get liquidity. So every time people's stop losses get hit, that means that the bank won the trade. That's what it means. It means you're giving your money back to the bank. And that's why we don't trade this way. So then what we would do is we would ride it to the downside. Here we would take a trade. Now this is a classical example. I love these examples because now where we sit currently with the market, which we've been trading this week, right? We had this breakup, right? So we closed our trades. I closed out my longs, my shorts. It was awesome. I took really good profit on that. I think I made like $144, which was really awesome. And then we had this first candle that broke up, right? This candle broke up. First candle opened, second candle opened. But now you ask yourself, okay, but whoa, no, Marnie, what happens now? Because you don't have a stop loss. So right on this candle, you took a trade. There I took a trade, right? Now you say, but whoa, this thing broke up. News came out and said, oh, America's really, really awesome. The euro is really crap. And the market turned against us. It threw these huge red candles. And what now, Marnie? Because now this trade is running in the red. That means that you are down on your position. So what do? I carry on trading. And this is where hedging comes in. So what happened? I was in this trade. It went up. I thought, sure, we're going to get a nice scoop. The bank said, no. We are going to turn the market against you guys. We're going to wipe out all these stop losses. And that's pretty much what they did. They came back. There my trade went into the negative. But remember, this is the first candle that closed or broke through the EMA, right? This is the second candle that opened underneath it, but it's the first this is the first candle that opened underneath the white line. This is the second candle, but I didn't take a trade there because the first rule is we open and close trades when the second candle opens above or below the ATMA. The second rule is we do not trade when we are 10 pips close to the 200, which is the red line. So normally when it gets to the blue line, which is the 100 SMA, simple moving average, we will start observing the market. We will look what the market is doing. When it gets to my 200 SMA, I will not take a trade. I will stand down and I will wait to see what happens. So what happened? The market then opened up its first candle underneath it. There was the next candle that opened and I took another trade because I'm thinking that the market is going to go further down. So I take a trade because remember, we've already had our candle. So I took another sell there. So here's my long, my buy. Here is my sell. But now Marnie, you got two trades. This trade is in the negative. This trade is in the negative. So what do I do? Guys, I'm simply hedged in this position. So what does hedging mean? Because I think this is very, very important to understand. There's two ways to have a stop loss. You can either put a hard stop where you get out of the market, or you can put a hedge. Now, a hedge means I put a buy and a sell, and it locks in the difference between the two trades. So the drawdown on this trade, so it means if the market comes back next week, like now, I'm actually going to open up a trade now. Why? Because I had my first candle, it came back through my 200, and then I had my first candle that opened. This is my first candle that opened. This is my second candle that has just opened. So what am I going to do now? I am going to take a trade. Because my job is to take trades. So right now, I'm going to be opening up another buy on Euro USD right now, and I'm going to be looking for some upside for next week. And what's going to happen now? What's most probably going to happen is this is going to push up. It's going to find some resistance here. It's going to push up. It's going to go through my buy. I'm going to have both buys going into a profit. When the market turns, I will close the trades, the buys that are on profit, I will close in profit, and I will take another sell, and I will ride the market down until this one is in profit. Rule number 3 is we never close a trade in a negative. We only close trades in positive. Guys, that is the strategy. We don't do anything else. We trade the market. We stay in our lot volumes. We don't go and play around and fool around with our lot volumes. We know what size account we have. We trade within our means. And this is what we do. We take the trades as the market gives them to us. Okay, so let me give you guys another example. So the question I always get asked is this strategy available on all time frames? Yes. You can trade it on the 1 minute all the way through to the 1 day. I would just recommend that 4 hours and 1 hour is about the best time frame that you can play with it, because you get good trades. You don't have to be a slave to your chart. If you're going to go under an hour with this strategy, you can do it. Nobody's going to stop you. You can do it. The difference is just you are going to be a slave, and you got to watch your trades, and you got to be more in the market. It's entirely up to you what you want to do, but this is pretty much what the strategy is. So right now, I will take another trade on this pairs on my phone now. So we don't trade on our laptops, we trade on our phones, and we take trades. The session is recorded. Okay, so you can watch what the strategy is. So all you got to do is keep taking trades. Your job is not to tell the market what to do. I'm sitting here. I've been trading the markets for over half a decade. My husband has been trading it for over a decade. I can't tell you what's going to happen in the market tomorrow or on Monday. I don't know. And I'm an experienced trader. I can give you my analysis, and I can say to you, okay, I think it's going to push up, because the euro is going to be strengthening against the dollar. There's some negative news coming in. I can't tell you. Any person that comes to you and says to you, I've got an indicator that's going to tell you 95% of the time what's going to be happening in the market. That's bull dust. I'm telling you that today. That's bull dust. It does not exist. None of us know what's going to happen in the market. That's why this trading strategy is so powerful, is because we trade price action. Now, if you go to any person and say, how have you become a successful trader? They will say to you, I trade price action. What the price tells me is happening, I trade it. I can't tell you if the market is going to go up or down, but it doesn't matter because I hedge my positions. And the reason why we work with a broker that we work is because we have no swap fees and we have no taxes. What does that mean? I can hold a trade for 10 years and I will not get charged swap fees. I will not get charged taxes. I get to keep all the profit that I make. So you need to make sure that you work with the right broker, because if you're not going to work with the right broker, eventually you're going to get stomped out of the position because your swap fees are going to be enormous, because every time you take a trade and it stays overnight, your broker charges you a swap fee. So that's why we work with the brokers that we work. That's why we don't tell you start with $10,000 in your account and start with X amount of money in your account. No, we tell you start with $100. And the reason why we say start with $100 is so that you get to know the strategy. You get to trading. All right. That's the important part, is the moment you get to trading and you keep trading the strategy, you're going to eventually see, wow, this is actually kind of good because I keep opening and closing trades. The ones that are going my way, they're not going my way. But I want to go back in the chart to show you guys why we use the hedging strategy. This is where we are currently in the market. So this is the current market we've been trading this week. But let's go back because I think it's important to understand how this strategy works and how at the end you actually end up very profitable. And this is why we've been able to make about 30 to 40% on our accounts every single month, because the strategy is so powerful. But I don't want to take it here. I actually want to go back a while, a time that I don't, random time. I want to do a random time so you guys can see how powerful. Let's say there. Okay, there we go. So let's say right now we are sitting here and we are looking at the market here. So this is the market that we're seeing, right? So now we're seeing the market is in and out of the candles. Now, whenever you see this, when you see this green and red, we don't trade. You will see on my Telegram group, I will also, and on my WhatsApp groups, I will say to you, guys, we are not going to trade. Not in this type of a market. The market is, and even the moving averages, they're all like, it almost looks like a spindle, they're coming together. We're not really going to trade there because this means the bank is drawing in liquidity. This is all that this means. The bank is looking at the retail traders and saying, okay, guys, keep placing your positions. Keep thinking and expecting what we are going to be doing. You cannot do that because we don't know. Then the next thing that happens is we get direction here, right? So we've got this choppiness here. It's out and then it's back in again. And then we see this big red candle, right? Yo, this is an enormous candle. When we think, okay, now it's time to take a trade. No, it's not time to take a trade, because what is rule number 3? Rule number 1 is we open a trade when the second candle opens above or below the white line. What is our second rule? Our second rule is that we have proper wallet management and we make sure that we follow the strategy. What is rule number 3? We don't trade close to the 200. When we get close to the 200, we close it out. Sorry, guys. Rule number 2 is we close a trade on a doji. So we close a trade on a doji. So if it's an uptrend and we see a doji, we get out of the market. So just look at this market. Look how many dojis you are seeing. Dojis are forming all over, which is telling us there's no direction. This market is just, it doesn't know what it wants to do. But let's say, for instance, you accidentally, you saw the market push up here, and you were like getting excited, and you're saying, oh, I want to trade. And we all say, okay, we're going to go and take a trade. So we take a trade because that's what we are. We are traders. We take trades. So what happens is this candle breaks up. This is our first candle that opens. Right there, our next candle opens. So we open up a trade because that's what we are. We are traders. We trade, right? I just want to create a different color here so you guys can see it apart from the red, the rest of them. So let's make it thick. So we take a trade because that's what we do. I don't know if that one's better. That one looks worse. Let's maybe make it a bit of a, I don't know, that's even worse. Let's make it, let's make it like a funny color. I want to actually do, let's make it like a green. Green is offsetting. Okay. So here we took a trade, right? So here we were excited. We said, yay, guys, we've got a trade. Let's go in. And we take an up trade, right? So we're going to make our up trades. We're going to make green. And our sell trades, we're going to make red, right? So here we take a buy trade because we're excited. We think the market's going to go up. Did the market go up? Yes, it did. As you can see, it did. But now the market comes back down. Here's the first candle that breaks through. This candle opens, but it shoots all the way through. This candle opens here, shoots all the way up, shoots back through. So now you're looking at this and you're thinking, oh my gosh, what the heck is happening here? we don't even know, because all these candles are going through and back and through. Eventually, the moving averages start spiraling. So, but we're still in this buy. We're still in the buy. It doesn't matter. We're here to trade. That's our job. We trade. Now the market starts to pull out and we think, okay, our buy is going in our direction. It looks like the bank is giving us direction. No, they're not. They're just trying to fool us. They're trying to take out stop losses. So what happens? The price comes back down. We're like, oh gosh, we're back into this whole thing. Then we see price go up and we're like, yay, finally we're getting some direction, right? Now what happens is we see this candle coming through. We see this candle coming through. We see this one forming, and we see this one forming here, right? So let's open this up so we can have a good look at it. So what happens here? Our strategy says when the second candle opens below, we close our buys. So we TP on this one. We close it out in profit because it is in profit. And now what do? We take up a selling position, a short position. Right there, we're excited. We are now taking a short. We're going to make this one red for a specific reason. So now we take a short. We're in a short. Down comes the market. Beautifully. Beautiful, beautiful, beautiful. It comes down. We're thinking, wow, this is great. But we also take cognizance of the fact that the 200 is coming in. The 200 is a very strong support or resistance zone. So we know normally when price gets around, that's why we don't trade around it, is because it's such a powerful reversal point or breakthrough and continuation. So the 200, this is a very important zone for the bank. And on the 4 hour, the 200 is the 100 on the 1 hour. So if you go down to the 1 hour, you're going to see that the 200 here, the 100 here is as a representation of the 200 on the 4 hours. So this is a powerful key level that the bank is looking at. So we need to be very careful when we are around that point. Now, where is my sell? Did you know? Oh no, there's my sell. Okay. Now I lost my position. Thank you so much, TradingView. So, I think where were we now? Okay, well, now I'm going to have to use a different example because it completely threw me out. Okay, so let's say we take a trade here, right? So this is a really awful one because we can see that the price reversed. So here we had a breakthrough. There we had our first candle. This is our second candle. Now, from my own personal experiences, I do know that any big candles like this are dangerous candles. Normally, if you are trading on the group with me, I would say to you guys, a candle like this is dangerous. It means somewhere some volume came in like this. This is even worse. So I would say to you guys, let's wait and see what the bank does. So we give it some time. But let's say, for instance, you are, no, Marnie, I'm trading this thing. It's the second candle that opened above, below the, I'm taking a sell. Okay, so now you're writing your sell down all nicely. Comes back. Here's the first candle that breaks through. Here's the second candle, the first candle that opens. Here's the second candle. But you can't close the sell because what is rule number 4? We do not close a trade in a loss. We don't. Never, 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 never. We wait because price will always come back. So what happens? Price breaks up. What do? We trade. That's what we do. We are traders. So it breaks through right here on this candle. You take a buy because that's what we do. So you've got the sell. So what is the negative part on your account? It is the difference between the two. Sura, don't you want to take them out, please? I can't in my Zoom so doen. Alright, so what do? Now, the only difference between these positions, right, is the difference in pip value here. So whether this price goes all the way up here, yes, this trade will run into negative, but you will never bust your account because the positive offsets the negative. That's why hedging is so powerful, and that's why we use it, because it only locks in that small difference between the sell and the buy. So there's no way for you to bust your account unless the market moves 100,000 pips. So if you can bring me a market that can move 100,000 pips in 1 week, I would love to see that, because they don't. They don't move that much. So now what do? We wait. Price goes all the way up, all the way up, all the way up, all the way up, right? And we're like, we are smiling. All of the ways we are smiling. Technically, you would have seen the doji here and you would have gotten out of the trade, right? So you would have closed off your buy on the doji there. So you would have watched the price. This is not a doji. The reason why it's not a doji is because it's square. You're looking for a rectangular body. That's the best way to do it. You've got a long wick and you've got a rectangular body. If it's square, it's a spinning top. It's not a doji. So on this doji, you would have closed this trade out, right? And the market would have put another candle, and the next moment you have this massive red candle that comes all the way down. Why did we not take any trades here? Because we are close to the 200. We don't take trades. That's rule number 3. We don't trade around the 200. Price comes all the way down. Oh, now we're smiling. Okay, guys, it looks like the market's going to be retracing. We're going to get some more downwards movement. No, that's not what the banks wants us to do. This candle was a liquidity sweep. So what did we have? This candle formed and the market kept going up. So this trade, we can't close the trade because it's not our rule. Our rule is we only close this trade once it shows us on the ATMA. So what happens? We hold this trade. We watch. Guys, the important part of this is to watch the market. And that's why I say on the group all the time, it's all about psychology. It's all about managing your emotions and understanding that trading is about balancing the scales at the end of the day. So what happens here? Here we get this price coming up. We got this one. There's the first one that breaks through. The next one pushes through again. Then we have this one that opens. So now this is the first one that opens above. This is the first candle that opens above the 8 EMA. This is the breakthrough candle. This is the first one this is the second one. So what do? We are traders. We take trades. So we take a buy. We still lock in the difference. We still lock it in. Our account's not going to do anything. What happens? We ride it up and up and up and up and up and up and up. The reason why we would have taken this trade is because there's still enough distance between the 200 and us. If it was this candle, for argument's sake, we would not have taken the trade. All right? We would have waited to see what happens. Do we get a rejection off it? Does it come back? So that's why this would have been fine with the 200, but a candle like this, so if you had seen this candle, I would have said to you, whoa, wait, let's see what happens around the 200. So what it did is it broke through the 200 and it kept going up. But what did we see here? We saw a doji. Right? There's the dojis, 3 dojis. So we would have closed this trade out. Right? We would have closed this trade out. And then what happened? Price moved all the way. It kept going up. Now we're saying, okay, maybe there's not a reversal coming. So what do? We check for the first candle. Then we check this next candle that breaks through. Now we see a breakthrough candle there. So what can you do? You go back into the market and you take another buy. Right? Because it is sometimes, some dojis, remember, only about 80% of dojis has a reversal pattern. It's not 100%. But that is a good indication for us because here, the doji helped us to get away from this. So that's why we close on the doji. So now, price carries up. Boom, 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 going up, going up, going up. Next moment, boom, first trade. Now, the next candle is a doji. So what do? We close our buy. We still have the sell at the bottom. Don't worry. That what goes up comes down. Guys, that's how it works. Now we had our first candle that came down. This is our first one that opened. This is our second one. So what do? We take another sell trade. So what's happening with the bottom trade, Marnie? But we're in such a drawdown. We've got there's so much difference between these two. Is my account not going to blow? No, it's not. Because as the market comes down, the loss on this one becomes less. The profit on this one becomes more. And it balances the books. And this is something that nobody teaches because this is how the bank trades. The bank trades is 80 million rand in the market a day. If they accidentally close that trade, they are doing insider trading. So they have to dollar cost average and they have to hedge their losing positions. That's how the bank trades. And they've been trading like this for years. So that's why we follow the same system. So what happens? We put in a sell. Price comes down. We're thinking great. Things are looking. We're observing the 100 moving average coming in. We see it bounces. It comes back in. First candle breaks through. First one opens. Second one, we close the sell. We close it. It's not a big profit, but hey, we close it. So what do? We take another buy trade. So this is the breakthrough. This is the first one. This is the second one. So what do? We take a buy trade. Again, whether the sell or the buys in this position is still hedged. And what do? We ride it all the way up. Here it comes. First candle breaks through. Next one pushes back up. Then we have this one on top. Now, there we have a doji. So what do? We close out the trade. Here we had another doji. So we would have watched. So either this one or this one, we would have closed out our trade. So we would have shut down this trade. Next moment, we're observing the market. So here we have price breaking below it. We're observing. Here is our first candle that breaks up above the 8 EMA. This is the first one that opens. This is the second one. So what do? We take a buy trade. Because that's what our job is. We do trading. But now the market right there where you put it in, the market says to you, nope, we are going to reverse on you. And it's exactly the same. Then we do exactly the same thing that we did before. Market comes. There's the first candle that breaks through it. This is the first candle that opens. This is the second candle. So what do? We take a sell. Because that's what we do. We are traders. So we got a sell. We got a buy, a sell, and another buy down here. Somewhere further down. Look how far this one is down. We're not stressing because we know the market's going to do what the market's going to do. And there's nothing we can do about it. Now the market goes down. Comes back up. First candle breaks. Second candle. This is the first one that opens. Second one. Can we close this sell? No, we can't. Because it is in a loss. Remember, rule number 2, we never, ever, ever close a trade in a loss. We don't. So what do? We take another buy. Right there. Now we have 2 sells, 2 buys. Price goes up, up, breaks down again. We got our trades, we got our sell here, we got our buy here. We want to see now. Now we're noticing, whoa, the market is telling us it doesn't know what it wants to do. So it breaks through. First candle, second candle, you can take another sell. Nothing wrong with that. Me personally, I will wait here because I've got 2 buys, 1 close sell. So I want to see a bit of direction before I take another trade. What's the next thing we see? We see the candle breaking up. So we're thinking, okay, these 2 buys are going in our direction. No, it doesn't. It breaks down. So we're thinking, okay, maybe the market's going to go down. So we've already got this buy and we got the buy sell at the bottom. So we've got the sell, we got the sell. Price comes down. We're thinking, yay, this is looking good. Price is going to retrace now. It's going to come down. No, it's not. It's going to go all the way back up. And what happens here? We've got 1, 2 buys. It breaks up. First candle. As a matter of fact, it breaks right here. Their price breaks up. This candle is the first opening candle. This is the second candle, right? We've got 2 trades in here. We don't need to place another one. We want to see some clear-cut direction. That's what happens. Price goes all the way up. Right here, price breaks through. Next one, this one. So what do? We close out both of our buys. And this is exactly the strategy we keep following. So now the question is, yeah, but Marnie, we're in all these positions. So we keep taking positions. And guess what? That which goes up shall come down. So we had this trade, right? Remember we had this trade? So right here, we would have taken a trade. Most probably, we would have watched the 200. We would have taken the trade here. It would have come down. 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 It would have kept coming down all the way here. It broke through here. We closed some of our trades. We are close to our 200 here. It will come back up again. We will trade the market. There it goes massively up. Look where this position is. We are stressing like crazy because this position is very far, and this is where we're sitting today. So I have one of these positions that's been open for a while. I'm not stressing because I know in the future the market will come down and I will close out my positions. But the difference is I never stop trading. So that is the strategy that we use. We don't overexert our accounts, which means we don't use lot volumes that rakes up 10% of our accounts. We only use between 1 and 2% of our accounts per trade. So that means if you have $100 account, if you start with a $100 account, you're only locking in $1 worth of risk into your trades. So you can take, on a $100 account, you can take 60 trades, and still not have blown your account, because that is proper wallet management. And that is everything that we teach you. That's everything that we help you with. If you get stuck somewhere or you made a mistake, you tell us, hey, I did this now. I'm not sure. Was I supposed to do this? And we assist you and we help you. But what the main aim of the strategy is, we keep trading. And we don't have to worry because we don't pay swap fees. We don't pay taxes. I can hold this trade. Some of my trades I've been holding for over 3 months already. But I know that which goes up is eventually going to come down because the market is like a wave. It's going to eventually come all the way back. The dollar is going to weaken. If it was there a while ago, it's going to come back again. And this is the strategy that we use. We don't use another strategy because it works. It is successful and it works really, really well. I just did the recording, so because there's some of the guys that asked me about it and asked me the strategy. This is pretty much how the strategy works. If you want to get started on this trading strategy, 3 things. Set up an account with FPS. So click on the link that I've sent you. Create yourself an account. Trust me, use the link that I've sent you because we have an agreement with FPS that anybody that comes in under our structure, they can have their swap fees and they can have their taxes removed because we are a hedging strategy. We need that. Second of all, I don't help people that trade on demo because demo is not real life. Trust me, the moment you put your own money in, you're going to get the emotions, you're going to feel that. So that's why I say the second thing is you need to fund it with a minimum of $100 so that we can get you trading. The account that you're going to be opening up is a cent account, which means every pip that the market moves, if the market has moved 100 pips or 200 pips in one day, that 200 pips is 200 cents. So you had a $2 drawdown on your account. That's a 2% drawdown. It's absolutely amazing. It's an account created for people that are starting out, people that wants to learn. As you get better in the strategy, you can at a later stage maybe use 3 or 5% of your account the moment that you understand the strategy and understand how we trade. From here, I only help on the Euro, USD, and the gold. You are more than welcome. Once you know the strategy, go try other currency pairs. It works on everything. It works on indices. It works on cryptocurrency. It works on shares. It works on everything. Everything that you look at, you can trade with this strategy because this is the strategy that is designed around market movements. All right, so that is pretty much how the strategy works. Let's just have a look at the end of the week. So where were we with trades? Currently now on Euro USD, I think we are in a hedged position. Let me just check on my phone. So we are currently in a hedged position on Euro USD. Let me just have a look here. Okay, so on Euro USD, we took a buy trade. All right. So we currently, yes, we are in a hedged position. We are between these two. So we took a buy trade right here. This one broke up. So we took a buy trade right there. Then the market came up. We had that beautiful news of yesterday where the interest rate, I think they brought, the interest rate went up by 0.25 basis points, which means the dollar will strengthen automatically. Came down and we took another position. We were checking this and we took another position right here as a sell. So we are hedged in these two positions. We don't know what the market's going to do. But right now, as we speak, we have just taken our third position right here. Why? Because we are above the 200-day moving average. We had our second candle open above the 8 EMA, and we are going to be trading towards the upside. That's it. Guys, that's how we trade. That's the positions we are currently running on